G'day and welcome to this week's video. My name is Rob Goudie and I thought it was probably time we discuss the volatility we're seeing in the market. So we're seeing a pretty significant correction and drawdown in the share prices around the globe, and seeing extreme volatility with particularly the Nasdaq last week dropped by nearly 4%. It was down by 5% during that day's trade. So we're seeing a huge amount of volatility, and it's obviously affecting our investment portfolios and superannuation policies, and it doesn't make us feel good. So this is where your investor psychology and our human emotions kick in, and sometimes don't lead us to make the best decisions at the toughest times. And this is where I really encourage people to talk to their financial advisor to understand what's happening, and in the short term as opposed to the long term in your investment time frame. But we'll go through obviously some of the things, what you should be doing, what you should be thinking about during these times when the market is correcting. Now, the double whammy to what we're seeing with our share prices, our portfolios, our superannuation, when the share prices are not at the peak at where they were. And that's one thing that I've been telling my clients, that it's, as humans and human behavior, we always remember the peak of our portfolio or the peak of a share price, and anything below that is a disaster. And it's not helpful to anchor our, to anchor to these high share prices or high portfolio prices, because more than likely over the last couple of years that the share market really ran away very hard after the COVID crash, and probably ran too far, and markets will do what they do. If it becomes overpriced, it will correct. So anchoring to these high levels of a share price or portfolio is really not helpful in the discussion of understanding your portfolio and what will happen over the very long term. Now, unfortunately, we also get a bit of a double whammy where we get the media that pumps up the bad news, and that's what the media do. It's not helpful at all. But again, it doesn't make us feel good, and it doesn't help us make the right decisions. So again, I would encourage people not to overly, put a lot of value in what is said in the media, where they say the Australian share market has lost $100 billion, in one day, which I think that happened a couple of days ago. So these are big numbers, but it means nothing in the long term. In the short term, they're just using it to frighten people for ratings or for whatever reason. Obviously, it's news, so they need to report it. These is what we're going through right now. Obviously, it doesn't feel good, but this is the reality. So what should we be doing, with these sort of times? Well, we need to understand, firstly, that we think, okay, the share market's come down, this is terrible, but it can get cheaper from here. So just when you think we're at a low, because we can't time this thing, it can get lower. So we can never time a market, and the market can do a lot worse than what you think it can do, and it can go a lot further up than what you can think it can do. So just know that. Also know that volatility that we see in share markets, because they're very liquid, they trade every business day, it's the ebbs and flows are huge, and that's actually normal because there's so much liquidity. So we can have all these events around the world, and markets can react to them that day, that moment. And when it comes to cryptocurrencies, they're trading 24 hours a day. So, the volatility there is just extreme. Obviously, what's difficult with cryptocurrencies is we really don't know how to value it. It doesn't do anything. What I would encourage people to do is consider your investment time frame. How long are you invested for? Now we see, volatility in the short term can be set off by terrorism, by wars, unfortunately, and geopolitical risk, and where we've got governments at each other, all these different types of risks. Obviously, increasing inflation, increasing interest rates are a concern, and these are weighing on the market at the moment. These are short-term issues. We need to consider your time frame. What is your life expectancy? And that's generally, our time frame that I talk to my clients about. Okay, you're 65, husband and wife both age 65. More than likely, one of them is going to make it through to age 90 and above. So that's the investment time frame. And when it comes to retiring, we just don't take our money all out of superannuation or all out of our investments and put it in cash. It gets drip fed over a long period of time, decades. So we're not selling down all in one hit. So think about your investment time frame. If it's still long, you've got to try to ignore what's happening in the very short term. What businesses are doing in these times, well, they're not sitting in the corner quivering and worrying about the share price. It wasn't where it was some time ago. People that are running businesses, think Microsoft and Google and Apple, they continually work hard, reinvest and develop and improve their products and services. You know, this is huge teams of very creative, very intelligent, very hardworking and passionate people improving products and services. And ultimately, improving products and services to their customers will mean they sell more. And more revenue will ultimately equal more revenue. And that is what drives share prices. Not the short-term stuff I just spoke about, but profit now and future growing profits is what will determine the price of the business and ultimately the market as a whole. So what are the things that you should be doing now? Well, I tell clients there's three things that you can choose to do. One, you can panic and sell at the worst time. And that's when the market's down, when it's crashing, when it's correcting. And these are what we're seeing right at the moment. Now is not the time to be selling. For the most part, where people don't have new money, holding is the majority of what people do. We've ridden through these types of events many times before. The tech wreck of 2000, the GFC of 08, 09, you know, these were big corrections. Clearly 2 years ago with the COVID crash, that was huge. You know, that was top to bottom, from a peak down to the bottom was around 37%. These things happen, they're normal, but we ride through them because we know, and I know, that businesses continue to reinvest, continue to develop, and that's what will drive the long-term valuations of the business. So holding is completely fine. And most people do that because most people, particularly in retirement, don't have more cash to commit and buy when it's cheap. The best thing to do when the market's down, and it's when you least feel like doing so, is to buy. So if you've got spare cash and it works within your risk profile, your asset allocation that you're comfortable with, we all need to keep good cash reserves aside, so we're never in a forced selling position to meet income requirements, but buying is the best thing to do. For people that have money within superannuation, and say it's in a balance fund that's 50-50, you've got the option to go from a balance fund of 50-50 to fund a different type of balance fund that might have, you know, instead of 50% in growth, might have 70% in growth. That's one way to increase your exposure to the market while it's down. Last point that you should be doing these times, that if you are feeling nervous, please reach out, talk to your financial advisor and get advice. It's really important you do that your advisor needs to understand your risk profile, the type of investor you are, and educate you to understand that this type of volatility is normal. I hope that's a help, and yeah, keep well, take care, and we'll speak soon. Bye.